Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion, the CEO and founder of Flying V, our digital marketing partner. Robb, how was your week?
Week was great. Excited for a new one with a lot of things happening. Yeah, but good weekend, good week, ready to get rolling. It's crazy. We're already into June. This year's flying by and only probably going to go faster with everything exciting we have coming up. How about you, Gary? How's your week off so far?
Pretty quiet here. Spring in Connecticut, there's always a lot of yard work to be done. So I spent a lot of the weekend cutting the grass, power washing some stuff outside, refinishing and sealing a deck, just all the good outdoor stuff. It beats going to the gym.
There you go. I like that.
Yeah.
Gary, this week's edition, we're calling it the No Rate Hikes Next Month issue. So I'm loving the tongue twisters that we're getting in our issues on a weekly basis is great. But we're talking PCE. We're talking the Fed again. Neel Kashkari makes another appearance. Fun hot button topic, GDP. I know you have a lot to say about that. We're going back to the Bank of Japan, and then we're talking a little bit of oil with ConocoPhillips as well as Marathon Oil and a acquisition to talk about there. You ready to get right into it?
Let's go.
All righty. Gary, thing number one, the April PCE we're talking about up 2.7%. What are the implications?
So first, let's explain what the PCE is. It's the Personal Consumption Expenditures Index. And the reason it's actually the preferred inflation gauge of the Federal Reserve. And the reason they look at that is the CPI, the Consumer Price Index, which is what people typically refer to when they're talking about inflation. That's a hypothetical basket, right? They sort of weight things the way they do. The PCE more closely matches people's actual expenditures. So if people are spending more, you see that in the PCE. If they're spending less, you see that. And so in some ways, it's a more accurate way to measure how families are being affected by inflation. And so the April PCE came in up 2.7% and up 0.3% versus last month. So first of all, 0.3% doesn't sound like a lot, right? It's like saying we have something that's $100 and next month it's $100.30. And people say, oh, why is that a big deal? And the answer is that 0.3% monthly annualizes to 3.7%. That's almost double what the Fed is looking for their inflation target. The core PCE, and that's the PCE excluding food and energy, that was up 0.2% monthly and up 2.8% annually. So all of those numbers were basically in line with expectations. There were no surprises there. The one thing that was kind of interesting is spending had been reported the prior 2 months as up 0.8%. Those are huge numbers. Those annualized to much larger numbers. They had been revised down to 0.7%. And then last month, spending was up only 0.2%. So they went from 0.8 to 0.2. That's a huge cut. And our view on it is the consumer may be tapped out. There's just been too much spending. Wages are not keeping up with inflation. And, we talked before last week about weak revenue at Target. And then last week, we saw declining same-store sales at Best Buy. All of these are indications that, it's just 1 month. So we'll see what happens over the next few months. But right now, it looks like the consumer might be running out of steam a little bit.
We had the Hawks and the Doves both having conversations about this after the fact and after these reports came out, with the Doves declaring immediate victory, right? Do we see much movement over the next 3-4 months, let's say, with elections coming up? Is there a clear winner? I know, as usual, we're still in the higher for longer, but I mean, how much movement do we actually see, if any, over these next couple months?
Well, so what happened was as soon as the report came out, it was in line with expectations. And the doves are people who prefer lower, they favor lower interest rates. And they were all over Twitter or X saying, hey, we win, the Fed's going to have to cut rates. And the hawks, that's the other side, the people who prefer higher interest rates, were saying, what are you kidding me? You're annualizing to almost 4%. You just had a 2.8% core number. These numbers have flattened out, inflation's sticky. But these were just people talking their book or yapping on social media. It's not really relevant. Our view here is that higher for longer is the way we're going to go. I don't think it's at all likely that the Fed changes the Fed funds rate at this meeting. And there are some people who think they might cut when we get out to like September or October. My view is at that point, we're really close to an election, and the Fed, they like to avoid the appearance of being politically conflicted. If they change rates close to an election, one side's going to be saying you're favoring those guys. And I just don't see it as that likely. I think we're going to be stuck at the current, 5.3% for a little while now. And that's not necessarily a bad thing, but that's where we are.
Yep. I'll come circle back to that here in a minute with one of my second questions. But moving to thing two, which will kind of piggyback a little bit. We're talking Neel Kashkari, president of the Minneapolis Federal Reserve. Kashkari signals even higher, possibly.
Yeah. Well, first of all, this particular group of Fed governors is the chattiest bunch I've ever seen in office. If we go back, like when I first started in the business, you didn't hear from the Federal Reserve. They were going to change rates. You saw it in a press release, right? They just put out a piece of paper and there it is. There's the rate. Now, in addition to Powell doing his usual, hour-long press conference every time they have the Fed meeting, I've seen weeks where 7 or 8 Fed governors will all be speaking. And I mean, these guys, it's like watching a reality TV show. They can't resist an open microphone, right? I'm pretty sure that I could actually get inside information from the Fed if I just put a mic stand and a lectern out in front of my driveway and just wrote on there, free microphone for Federal Reserve governors. I think they'd start flying in, because why wouldn't they, right? These guys, they can't resist an open microphone, and I'm not sure why they feel the need to be talking as much as they do. I'm not sure they're really lending a whole lot of value to the process, but here we are. So Kashkari was speaking last week, and remember, we came into this year with people expecting a total of 6 rate cuts. That's 1.5% off the Fed funds rate, starting in January. And DKI said, not a chance, higher for longer. And then, that got cut to 4 cuts, and then 3. And, now the discussion was kind of like between 0 and 2. And Kashkari came out and said, yeah, maybe we need to raise rates. Now, the truth is, he's actually right. And I know there are a lot of people who don't like hearing that. There are a lot of people who want asset bubbles and higher asset prices. But the truth is, for every time Jerome Powell says that the current Fed funds rate is restrictive, I completely disagree. We still have inflation. We still have inflation running well above where it should be at, right around, 1.5 to 2 times, depending on which index you're looking at and whether you're looking at monthly or annual numbers. But, much higher than the target rate. And so, and also the real rate of interest is still below 2%, which is pretty low. So I don't agree the current rate's restrictive. Kashkari may be right. But it was really interesting to see a Fed governor actually saying, maybe we need to consider hikes.
With that, can I get you to put some odds on the opportunity or the chance that Powell does hike rates? I know we've talked about this a little bit, and obviously not what a lot of people want to hear, but will they, or when would they? Gary, got any good
All right,
odds for us?
let's put numbers on it, right? We'll take a guess. Yeah, oh, Rob, great. You're taking notes. Terrific. All right, let's put numbers on this. I think there's a 70% probability that we end the year right where we are now. No rate changes, maybe something in December, but I don't think they're gonna do anything before the election.
Yeah.
There's 20% probability that they cut once or twice, a 10% probability that Kashkari ends up being right. Inflation does continue to be a problem or tick up, which could happen, especially if fuel prices go up again. More on that later. And, if that's the case, maybe they would hike once. So 70, 20, 10, that's where I am on it.
All right. I like that. That sounds good. At least putting some numbers on it.
Yeah.
Sounds like a lot of things staying the same. Again, as you've said, the Fed not wanting to rock that boat prior to November. Gary, any other points? I know you had a few more takeaways here. Anything else to add on thing number two?
Um, I think that with inflation right around 3%, it's not crazy for Kashkari to be saying maybe we do need to hike again. The other thing is, look, every time Powell steps in front of a microphone, people ask him, when are you going to cut? When are you going to cut? And that's everybody's bias. But just because that's what people want doesn't mean that's going to be the next move. The other thing is, there's a danger in projecting what's in somebody else's head. The truth is, most people don't know why they do things, let alone for us to have the ability to figure out why they're doing something. They may not know themselves. And so I understand that what I'm about to say, is a little bit dangerous only because I don't know what Powell's thinking and he may not know. My sense is he's somebody who's very concerned with legacy. If he puts the US into a recession, but gets inflation under control, he can be okay with that. The thing that he doesn't want to do is he doesn't want to be the next Arthur Burns. We've talked about this before. Burns was the chairman of the Federal Reserve back in the 1970s when the US had its worst inflation problem in, the last 50 to 100 years. And it took Paul Volcker, who was the chairman after him, raising rates to around 20% to get that fixed. Now, the US government doesn't have that kind of flexibility now because with 35, $36 trillion of debt, raising rates that high is simply not feasible. We can't afford that kind of interest expense. So Powell doesn't have that much leeway. But I think in terms of his legacy, he really doesn't want to let off, turn dovish, reduce the Fed funds rate, have inflation come roaring back, and then have to raise rates even higher. And if Powell has to raise rates to somewhere in the, 8, 10, 12% range, he will be reviled throughout history. And I don't think he has the stomach for it. I don't think he wants that. So, sometimes you have to take a guess at the personalities involved here. And I I haven't met Powell personally, I'm guessing, but that's my view on sort of his payoff matrix for policy action.
Thing number three, increasing Gary's level of micro famous, I think we could call it with this next one potentially. Gary, thing number three, the government revises GDP down, and you're saying that you're expecting hate mail.
Yeah, every time we talk about this, people get angry. There are some people who really love government spending. It is their reason for existence. If the government's not paying for it, it's evil, right? The private market is horrible, but no matter how much the government spends, it's terrific money. So, I get hate mail from those people, and my simple response is all of you are wrong and don't know anything about economics. So, great. We hate each other. Anyway,
Yeah,
the
I think this is more advocation for doing live stream, right? And
yeah,
you'd probably have the mail piling up by now already.
yeah, whatever. Anyway, um, so first quarter GDP was originally reported at 1.6%. That's not a tragic number. It's not bad. But that was revised down to 1.3%. That's a really big change. Now, listen, I understand an economy as large as the United States. This is a big country. It's still the largest economy in the world. We've got somewhere close to 350 million people here. I understand it's difficult to keep track of all that, to quantify everything, but shifting down from 1.6% to 1.3%, that is a big, big change. Even worse, more than 100% of that now 1.3% growth came from government spending. So this is your regular reminder that government spending adds to GDP, whether it creates value or not. And so, the example we always give is if I gave, a bunch of people $1 trillion to dig holes, and then another group of people $1 trillion to fill in holes, we'll have created no value, but we will claim $2 trillion of increase to GDP. So government spending can absolutely just destroy value. And that's what we're seeing here. We had an increase in government debt in the first quarter that far exceeded the increase in GDP. And so the only way that that math works is to assume two things. One, that government spending is destroying value. And so for all of you MMT, all of you modern monetary theory fans out there, sorry, but this government spending is absolutely destroying value. And the other conclusion you can draw is that right now, all of the economic growth we're experiencing is government spending, government jobs, things that aren't creating value. And if that makes up more than 100% of economic growth, then what that means is that the private market is declining. So we have a bifurcated economy here, right? We have government spending that is pushing out the growth of the real economy or the private economy, the things that citizens do voluntarily without being coerced by the government.
Gary, we're obviously spending into oblivion. That much is obvious. Is there any tune in that this spending is used to inflate these numbers, or is there not even that much thinking going on, or how much strategy, right, it goes into some of these things that are happening at the level of Congress and when they're determining spending, and then how, as always, they're trying to what seems to be spin this spending to the public?
Rob, that's a great question. And I'm going to reframe your question because it's such an important one. When you see people doing things like this, you have to wonder, are they acting out of ignorance or malfeasance? Right? Do they not understand economics? And I'm a firm believer that there is nobody in Washington whose last name isn't Paul. You know, Ron and Rand Paul do understand economics, but most of Washington is economically illiterate. So do they not know? Or they know and they don't care. They'll destroy the economy because it's to their benefit to do so. And in this case, I actually believe that, you know, everybody, we're heading for a big election in November. And I believe that this excessive spending is because nobody wants to run for reelection when the economy is in a recession, right? The US are number one. If you want to predict who's going to win an election, look at the state of the economy, right? If you're running for reelection in a recession, your chances of winning are very, very low. And for clarity, I'm not blaming all of this on the White House. This is a bipartisan problem. The Republicans are huge spenders as well as the Democrats. Nobody wants to run for reelection, whether you're in Congress, the Senate, in the White House. Neither party wants to do this. And so they're spending excessively in order to keep the economy propped up. And this is one of the things we've talked about at length before because it's a dilemma for Powell. What does he do when he's trying to slow the economy to get inflation under control, but Congress and the Treasury Department are intentionally running up huge, huge bills to stimulate the economy? And, you know, the Congress is basically, we've talked about this before a lot too. They've decided that they want to fund the government through inflation because then they can blame greedy corporations, they can blame Putin, they can blame everybody else. But, you know, they duck the blame on that themselves. So, you know, we'll have guns, butter, bread, circuses. But in the end, I just want to remind everybody we're all going to pay for our free stimmies with more inflation, right? People liked getting those big government checks. So, you know, people got $800 checks or $1,600 checks, but then they saw their monthly expenses going up by $100 or $200, and that's permanent. And so, you know, great, you got your, you know, your $1,600 once, but your monthly, your annual bills are up by $2,400 every year. We're all paying for our stimmies. Nothing is free, and they're destroying the currency. And I don't know if it's intentional or not, but I do know they know what they're doing and they don't care. They'll wreck the economy. They'll destroy the dollar because it gets them reelected. And again, it's both parties do this. It's not, I'm not picking on one party or another. I think they're both guilty of overspending.
Thing number 4, Gary, we're moving back to the Bank of Japan. The BOJ is finally considering raising rates again. Bigger rate increase than last time?
Well, the last time, what did they went from negative to 0.05%.
Oh, you're giving them too much credit, I feel like.
Yeah,
I think
exactly.
it's 0.02 or something.
Yeah, it was, I mean, it was something insane. Oh, I think it was
Something like that.
0.05%.
We'll look it up later.
Yeah, it was something insane, right? They telegraphed it. We're going to raise rates. We're going to go positive. We're going to go positive. We're going to raise rates. And then,
That's what it was. Go
yeah,
positive. That's right.
right. And they ended up like between 0 and 0.1%. So at the
They
end of
went
the day, it
positive.
was, yeah, it was, they did it, but anyway. So needless to say, that effort did not help. The yen kept falling. I think, last time I looked, it was 157 yen to the dollar. Just a couple of years ago, it was 102, 103 yen to the dollar. So their currency has fallen more than 50% against the dollar in 2 years. Then what they did was they blew through tens of billions of dollars of foreign currency reserves in an attempt to defend the yen. So the way that works for people who aren't so familiar with this is, Japan, they're holding lots and lots of foreign currency, and a lot of that is in dollars. So what they were doing is they were selling dollars or selling US treasuries, which is, a way to hold dollars, and then using the funds they got from that to buy the yen. And that would strengthen the yen. The issue is because the Bank of Japan didn't address the underlying problem, right? The underlying imbalance in their economy. Those efforts would typically work for somewhere between 24 and 48 hours, right? This is like, if you were a football player and you had a bad injury, they might be, your trainer might be able to give you a steroid shot or a numbing shot, in your shoulder or your knee to allow you to play, but that doesn't fix the injury, right? By the time the game is over, you're going to be in pain again and still haven't gone through the hard work that you have to go through in physical therapy. That's the situation they're in now. So they blow tens of billions of dollars and it buys them a small reprieve for 1 to 2 days, and then everything falls back the way it is. So they're looking for their next inflation report, and they're talking about raising rates again. And what we've seen is, I've got a chart here. Andrew is going to put up the chart, but the yield on the Japanese 10-year government bond this year has gone from 60 basis points or 0.6% to almost 1.1%. That's a big change, in just 5 months. So, and they're going to have to raise it again. Whether they do or not this time, I don't know, but at some point they're going to have to.
I've seen some conversations on X and just other platforms that there is some mirroring between, what Japan and the US look like compared to one another. Obviously different scales in terms of size, but any similarities with the situations one way or the other, Gary?
There absolutely is. The issue with Japan is because they ran such low interest rates and even negative interest rates for almost a decade, they were able to run up huge debt. The Japanese debt is something like 260% of GDP. Well, the problem is when we started to get inflation in the US and the UK and the EU, all of the central banks started to raise rates. The Bank of Japan couldn't raise rates. And the reason is, with debt to GDP of 260%, they weren't able to. If your debt is that high, higher rates will crush your budget. So they couldn't afford it. And as a result, they kept their interest rates ultra low, for until very recently negative. And what that did was that crashed their currency. And that's generally a problem, but it's a huge problem in a small island nation without a lot in the way of natural resources, without a lot of fuel. And so that created huge problems for them. And now they're really stuck, because if they don't raise rates, their currency is going to continue falling, and that's going to make life pretty expensive. If they do raise rates, well, guess what? With debt that high, they can't afford it. And so these are the same problems we have here in the United States. We wrote an ebook in the fourth quarter last year called Counterintuitive Inflation, explaining how in the US our debt is so high that if the Federal Reserve hikes rates, it's going to increase our interest expense. That will increase government debt. That will lead to more currency printing, and guess what? More inflation. So we're trapped here in the same way Japan is. It's just for them, the problem is much larger, and they're going to need to deal with it before we do. But at some point, everybody in the Western world is going to have to deal with this problem. Not just Japan, not just the US. The UK has similar problems. The EU has even bigger problems than the UK. But it's going to be Japan where we see these issues first. But everybody's facing the same dilemmas for the same reasons.
Getting to our final thing for this week, Gary, talking oil. Thing number 5 of this week's version of the 5 things. ConocoPhillips, ticker COP, announces a $22.5 billion acquisition of Marathon Oil, trades under MRO.
So Marathon Oil, their stock this year has traded almost exactly like a proxy for WTI. That stands for West Texas Intermediate. That's basically our domestic oil prices. When we look at international oil, people talk about Brent crude. In the US, we look at West Texas Intermediate. Anyway, Marathon's stock price has been almost an exact mirror. And we have regulatory issues here in the United States where the oil companies are strongly discouraged from going and doing more exploration, production, drilling. The environmentalists are concerned about that. And whether they're right or wrong doesn't really matter. The answer for a lot of these companies is if you can't go find new fields and drill them and produce in them, then the way you grow is by either buying back your stock or acquiring competitors. And so Conoco figured $22.5 billion. Let's buy Marathon Oil. And they actually got the timing right. Just as West Texas Intermediate took a little bit of a downturn, they paid a pretty big premium to get the deal done.
Gary, DKI has long supported oil energy investments, especially in the current economic situation. Reliability, potential as a hedge against declining purchasing power. You also note that further consolidation in the industry will also benefit those oil and gas positions. How come?
Well, if you own oil production, if you own oil majors and the industry's consolidating, instead of producing more, then what that means is you're not going to have more production. You're just going to have more concentration that leads to higher oil prices long term. It's one of the reasons why we like owning those positions. We've been long energy for a couple of years and very profitably so. I think that'll continue to be the case for a while. The other thing that I'd add is if we think about all of the things that people have in their lives, they're looking forward to from a material point of view, there's a huge correlation between material quality of life and energy usage. And very few people on this planet are volunteering to live at a lower standard of living. Again, we're talking about material goods. I'm not talking about the things of wonderful, but non-tangible value like, friends or family or relationships. Those are the things that I think have the most value, but, we're talking about finance. So we're talking about tangible things. But remember right now all these people they want more electric cars and electrification of everything. Okay, well, that might result in less fuel usage, but boy, are we going to need some grid improvements for that. And nobody's working on that. Also everybody likes having cloud services, right? I'm one of those people. I'm one of those work from everywhere people. I travel all over the world. I work from everywhere. Well, guess what? I need to have a lot of stuff in the cloud, and everybody's very excited about AI. Well, those NVIDIA graphics chips, the AI ones, they use huge amounts of energy. And, we talked about this. We had Enrique Abeda on recently talking about Talon Energy, a really interesting investment. So ultimately, we're either going to need, if you want reliable baseload power, you're talking about coal, natural gas, oil, or nuclear. The so-called renewables, that doesn't work for baseload generation, at least not yet. So there's going to be increasing demand for electricity and for energy, and nobody's volunteering to live at a lower quality of life. So here we are. We're looking at, more acquisitions in the space, more consolidation in the space, and I think long-term higher energy prices. the way we've responded to that is by owning a lot of oil related investments and owning uranium, because I think nuclear is the way we're going to have to go to make all of this work.
Gary, thanks so much for this week's version of the 5 things again. As always, please head to our website, consider a premium subscription. Premium subscribers receive the 5 things Monday morning, right at the opening bell. Free subscribers receive a truncated version of the 5 things on Wednesdays. Would love if you would consider supporting DKI and our initiatives here to continue to produce high quality content and information. Coming up this week, Gary, too, wanted to highlight Wednesday. We've got a pretty exciting webinar. Did you want to tell everybody about that?
Yeah, that's right. On Wednesday at noon, we'll be hosting the management team from authID. We've talked about biometric security and authID. The ticker is AUID, but we've talked about them in the 5 things before. We will be live streaming with the CEO, CFO, Chief Technology Officer, and a member of the board of directors. That'll be Wednesday at noon Eastern time. We will have the video up on YouTube that afternoon. We'll be live streaming to my Twitter or X channel. That's at Gary_Brode, Brode, or to LinkedIn Live. You can look and find me there. So you can watch that live, or check in Wednesday afternoon, Wednesday evening. We'll have the video up there. Separately from that, I'm happy to say I'll be the featured guest with Michael Guyot and Title Financial Group for their Get Think Tanked on Thursday evening. I'm not sure how much drinking is mandatory, but I'll find that out beforehand. And, we'll be talking about all kinds of interesting things in finance, macro, the markets. A really interesting group of people there. I want to thank Michael for hosting me. He's been a terrific friend and partner. So lots of content coming this week.
Thanks everybody for watching, and be sure to again check out those few events coming up later this week. And for all things DKI, you can check out our website at deepknowledgeinvesting.com. Gary, thanks so much as always.
Thanks, Rob. Great doing this with you. Everyone, have a terrific week, and we will see you next Monday. Thanks.